Well, hello everyone and welcome out to this Maverick presentation on earnings calendar trading ranges. And I don't know the exact title. Trading ranges on earnings is probably the correct title. We're going to go through how earnings impact the implied volatility of the options. There's a tendency to have them inflate going into the earnings report and then deflate afterwards. We'll talk about what that means in terms of expectations for movement, how to build some trades off of that, and some statistics behind it. So should be kind of fun. I'm going to start here by going to the Nasdaq earnings column. And if we go into the earnings calendar for Nasdaq, we could actually search for symbols. If you had a specific company that you wanted to look for, you can search for it individually. The other thing you can do is actually go by date and see what's reporting on such and such a date. And so we can take it either way. Let me show you what I mean. So let's say we were interested in when Walmart was going to report. I can type in Walmart symbol, choose that, hit enter, and it shows us August 16th. Well, I know that's okay, that's coming up in a couple of days. If I go back, I might have run into Walmart as I was going through the calendar, and I say, okay, well, what's going to be reporting on Thursday? And if I click on Thursday, I go through here and start to look at different companies. Well, down at the bottom, I would have run into Walmart. Notice the pre-market has a certain symbol, has the sunshine there. After hours, it has a different symbol. That means when do they actually report their earnings? Walmart's going to report Thursday pre-market. That means that the last trading day to get into something for Walmart's earnings would be Wednesday. So if you were going to get in before earnings, you'd have had to put on your trade Wednesday because Walmart's going to report Thursday morning before the stock market opens. So you can see a variety. Nvidia, for example, reports on Thursday after the bell and so forth. Now I wanted to go into today, and we had a couple of earnings reports that came out this morning. One of those that's a big name stock was Home Depot. And I want to talk about a little bit in terms of this expected range and the statistics behind it and so forth. And we can see that Home Depot reported, and the headline was, big earnings beat for Home Depot. Why? Well, look at the 225 versus the 284. If I scroll back up to what that is, here it's going to show you last year's EPS versus, the consensus EPS forecast versus what they actually reported. So if you take Home Depot's numbers, for example, here's last year, here's the consensus, and then what did they do? They actually beat that pretty handily. You can see that this is a very widely followed stock. There are 14 analysts that follow it, number of estimates, and the bigger the number of estimates, the bigger the company, the more liquid the company tends to be. And, that gives you a sense that here, nobody's following it, right? Zero analyst forecast, zero. Here's one. Well, Advanced Auto Parts would be decent to trade. There's 10 analysts following it. Or Brinker International, I saw here, 7 analysts following that. You would recognize a lot of the restaurants that are in the Brinker family. 14 follow and gave an estimate for Home Depot. Now, if we go to the headline, that might be fun because the headline doesn't always suggest what the actual result is. So let me go into Home Depot, see if it has the headline up, big earnings beat and so forth. Here I'm going to go to a different website, Yahoo Finance. If I type in Home Depot, let's see here. Well, those were pre. Where did I see the headline? I was going to show the big headline of Home Depot beat, but maybe they've taken that down since the stock's actually going down. I thought this was kind of interesting because the big headline was huge earnings beat by Home Depot, yada, yada, yada. You look at their chart and they're selling off. And so the first thing we need to consider is that just because you beat on earnings does not mean your stock price is going to go up. Just because you missed doesn't mean your stock price is going to go down. Earnings can be kind of helter-skelter that way. Earnings are tough because You can beat and go down like we're seeing right here. You can miss and go up. A lot of it's built into forward-looking expectations. Maybe there's an expectation that their earnings have peaked and they're going to start to see slower growth, or whatever that reasoning may be. You can see some of that. Now, Home Depot hasn't moved a lot, but what it is moving, it's moving lower. And when I say it hasn't moved a lot, that would be primarily versus the expectations going in. So the question is, how much was the expected move, that's the trading range, versus how much did it actually move? And a lot of the time, basically I'm going to call it about 2/3 of the time, the stock price movement will be underwhelming. So people say, well, I'll sell volatility because of that. The problem is that the 1/3 of the time that it is, and you're better off buying volatility, those can be huge payoffs and huge risk to the seller of volatility. So there's no exact science, meaning the market's efficient enough that you're not finding massive discrepancies. It's not like you're going to find a trade strategy that works 2/3 of the time and on top of that gives you a massive reward and little to no risk and so forth. It just kind of doesn't work that way. But can you trade around it and be very effective managing your risks? I think you can. The reason I caution is because some traders might say, well, I'll just always sell volatility. I have probability on my side. Understand that some of these, like this Facebook disaster, this was the largest market cap drop in a single day, and it happened on Facebook's earnings. Largest of all time. Now that's a pain. That was not expected. That was not priced in. And if you had some sort of naked option strategy, that you're waking up to a massive disaster that could have gotten even worse a couple of days later and forced you out at a massively lower price and a very bad result. So first rule of thumb, whatever you do, don't go in naked with over position size. If you're going to do it, it should be small, reasonably positioned size. Next, probably better to do limited risk, limited reward trades unless you're really confident on your position sizing, your risk management, some hedging techniques, and so forth. Now, let's talk about Home Depot and the expected move. So Home Depot was trading at roughly 194 at the close yesterday. And as it was trading at about 194, the at-the-money straddle for Home Depot was going for somewhere in the neighborhood, and this is this week. This is the August 17th, so they expire this Friday. The at-the-money straddle was going for somewhere in the neighborhood of $7. Okay? Now, why was it going for $7? Because they said, you know what? Based on the volatility and the expectations and so forth, we think this thing could move up or down quite a lot. And that was a pretty expensive straddle from really kind of where it seemed like it could go and whatnot. I mean, here's your expected range, $7 up and $7 down. I'm going to take you through that a little bit more. The point is, it's dead in the middle and has only moved down about $1.40 on the day. So what did that do? It caused all the options to collapse. If I pull up the Home Depot example here, look at all the red. Red on the puts and red on the calls. Even more red on the calls, but plenty of red on the puts. Why? Because there was such a built-in expectation. Here you can see it. Implied volatility has dropped by a large degree. It's dropping rapidly. Because there hasn't been a huge move, even though the stock's gone down a little bit, they were pricing in so much more of a move than that the puts have lost value. Because if you go in, think of it in terms of expectations. This is like an insurance contract. And somebody says, I think that this disaster is going to cause $10 billion worth of damage. And then there's only $2 billion. Even though there's some damage, it's so much less than the expectation. They paid way too much premium trying to profit from a huge disaster. And so the small little disaster that's happening at Home Depot, it's tiny, it's down to $1.40, wasn't enough to compensate how expensive these options were betting on the bigger disaster. I hope that makes sense. It's kind of like an insurance contract that way. Now, the calls are going to lose because they're also losing that volatility game, but they're also going the wrong direction. So they're losing intrinsic value plus time value plus a big volatility drop, what they call a volatility crush. So when we look at this, let's back it out and see what happened to Home Depot and compare an example that might happen with earnings this week. So I'm going to take something that reports, well, let's go to tomorrow. We can choose something that reports in the morning or at night. It won't matter. We do like to use weekly options for this analysis because it really isolates that this is an earnings result, that's how these are priced. And in fact, let's go to Thursday. Thursday, I know Nvidia reports after the bell, and we can really, kind of break down those numbers. And this is a volatile name, so it'll be kind of fun. It has pretty liquid options, et cetera, et cetera. So here's Nvidia, okay? 4 analyst estimates. You can see last year they reported 92 cents. That they're expected to report 164. They'll probably beat that number. That doesn't mean the stock's going to go up, but they'll probably beat that number. 4 analyst expectations. They report Thursday after the bell. Thursday after the close. That's all that data right there. Now let's go look at the options and take it one step further with Nvidia here. So I'm going to pull up the option chain. Again, we can use the weeklies. This has weekly options, which is one of the reasons I chose it. They expire on August 17th. So think about it. The company reports on August 16th after the close, and then it has Friday to trade these options, and that's it. So when these options are priced, the way they're priced is really pricing in a lot for earnings. And we can kind of think about that and isolate it. I'll show you how to do that. So Nvidia is trading around 260-ish, 261, but I'm going to probably call the 260s the at-the-money strike. And that's what we need to find first, is where is at the money for the asset? Because as I look at the option chain, I need to find those at-the-money options. So if I come in here and look at Nvidia, sure enough, the at-the-money strike is the 260. Now the 260 strike is trading on the call side for about 850, 860-ish. On the put side, 715 by 730. That's the total cost of the at-the-money straddle. I can add those two together, and that tells me how much it would cost me to buy volatility on this event. So if I were buying the 260 calls and buying the 260 puts simultaneously, I'm going to pay about $850 and $725. I'm going to keep the numbers simple. So we're going to pay $850 and $725. Now some of you say, well, if we're buying the straddle, we have upside potential and we have downside potential. And that's correct. If you're buying the straddle, if it's a huge move up or a huge move down, you stand to profit. Why? Because if we blast off to the upside, our calls are going to gain a tremendous amount of value, and the puts can only lose their 725. So if our calls can go up by, if the calls can go up to 20 points in value, it won't even matter that the puts expire. It's worth 20 and we paid $15.75, we've got a profit, or vice versa. Imagine the stock collapses, your puts would be worth so much it doesn't matter that the calls expire, right? This is the straddle trade. Now, a trader could buy or sell the straddle, but the straddle is very good at analyzing and kind of isolating some different things. First, let's talk about the straddle itself and probabilities. The straddle is really designed to lose. This is a losing strategy most of the time. The reason traders will take it is because there are big payoffs if it works, right? But it's not a great bet. So if we look at kind of the curve of probabilities and payoffs and so forth, I didn't draw that perfect, but here's our 68%, which is one standard deviation. So 68% of the time you land in this zone. That's what the straddle is. In other words, we can take the straddle, add it to the stock price, subtract it from the stock price, and it gives us the expected range. And the stock is expected to finish at expiration in that range the majority of the time. So in other words, so if the stock's at 260, I'm going to add the straddle, 1575, and that gives us a total value of 275.75. That's up here somewhere. Okay, 275.75. That's the upper end of the expected range. And what's the lower end of the range? Well, we take the at-the-money straddle, 260. We subtract the straddle value, 1575. So 260 minus 1575 is 244.25. That's down here. So when we look at this trade, the options market is actually telling us that 68% of the time, about 2/3 of the time, it's going to finish in this range, right? Statistically, that's probable. But that leaves us with 32% left over. That tells us that 16% of the time, you're going to have a bigger outlier up here. You're going to move outside of one standard deviation to the upside. And 16% of the time, you're going to have a huge standard, blowout number, or poor number, or whatever it is, but not even necessarily bad number, just huge reaction to the downside. That's going to happen maybe 16% of the time. It's going to go beyond one standard deviation to the downside. These are not high probability, but they have big potential payoff because the straddle has limited risk. If I buy this straddle, not if you short it, but if you go long it. If I go long the straddle, I buy these two options. Then think about my risk and reward. And this is what gets people excited, even though it's not a great bet a lot of times. 1575, what I paid for these two options, is my risk. I can't lose more than that, right? And I should also mention the probability of losing the full amount is not good. It's not high. Why? Because it's not going to land imperfectly at 260. If it were to land at exactly 260 at expiration, then both options would be worthless and we'd lose everything. But any other number, if it finishes at 262 or 265 or 254 or 248 or whatever, we'd lose something, but it wouldn't be a max loss. So max loss is very unlikely. Partial losses, very likely. Big losses, very likely. Probability of losing something, very, very likely, right? But the max loss, you'd have to land imperfectly right on top of the strike prices to not get something back, because at least if you're a little above, you can sell your calls for something. If you're a little below, you can sell your puts for something. You might be taking it on the chin and have a big loss, but it's not a max loss. Now let's talk about reward. Well, reward is unlimited. It's infinite. And forgive my infinite symbol here, but anyway, it's undefined, right? Imagine we wake up and Nvidia is trading at $210 per share. Well, if that were to happen, the calls are toast, right? We lose the 850, but who cares? Our puts that we paid $725 for, they're a 260 put, stock's at 210, they're worth $50. You paid $15.75 for the trade, and it's now trading at $50 of value. that's not likely to happen. I'd be absolutely mind-boggled if that happened. But that's what Facebook did. That was that type of reaction in Facebook. It was catastrophic type of move. I mean, stock was down well over 20% overnight, and even worse a couple of days later. That's catastrophic type of stuff, in that scenario. So just understand kind of the risk and rewards and probability. This is the way you take the at-the-money straddle and you can price out the expected move. Now, if we really think about this, how much of the straddle is pricing in earnings? In other words, the straddle would always be priced at something. There must be an earnings premium, a little extra, because there's really a couple of things we know about earnings. Number one, we know that earnings tend to cause a stock to be volatile. So that's part of why these options are inflated is, hey, look, stocks usually are more volatile the day after their earnings than on a normal day. So it does bring some stock volatility. However, the other things we know are, number two, volatility tends to get expensive, or it inflates. Premiums inflate. They become more costly going into earnings. And number three, volatility tends to deflate right after earnings are given, right? Deflate after earnings are announced, meaning premiums tend to get expensive going in and tend to get kind of collapse, volatility crush, tend to drop in value thereafter. So if you want to know the earnings premium, you'd basically have had to be tracking what at-the-money straddles were going for normally in Nvidia. And we can maybe kind of get a sense of that before and after. In other words, if you had looked at Nvidia's straddle last week, it would have been X amount. Well, let's say that its straddle last week was $9.75. And the week before that, it was around $9.75 and so forth. Then we'd say, well, a normal straddle in Nvidia is $9.75. This week, it's $15.75. So what's the earnings premium? What are you paying above and beyond for earnings? Well, it's $6. That's how much extra you're paying for the nervousness that people have around earnings. And that's a good exercise to kind of put things into perspective. So let me show you what I mean by that, because I think this is a good homework assignment that you can all go out and do. Let's take something that reports next week. So I'm going to go into next week, and then we can compare it to this week's straddle, right? This will be kind of a way you can do it. So if we look at, here's Kohl's, that could be a candidate. So Kohl's reports next week, actually a week from today. So if we look at Kohl's earnings, options going into earnings, we say, okay, let's pull up Kohl's options, and we can look at this week's straddle and then compare it to, it won't be perfect to compare it to next week until next week, but anyway, Kohl's straddle, so the stock's at 78.33. With the stock at 78.33, we're going to find the at-the-money strike price, which is 78.50. The straddle this week is going for $1.50 by $1.50. So the at-the-money straddle for Kohl's is $3. This one does not include earnings. This one expires this Friday. So this is X earnings. They call it, X dividend is when you start trading without the dividend. X is without dividend. So here's our X earnings straddle. So a normal straddle in Kohl's might be in the neighborhood of $3, right? Do you think that next week that this will be more expensive than $3 going into that? In other words, this one has 3 days to expiration. If we were to look at this next week before Kohl's reports their earnings, do you think it's going to be going for more than $3? Well, my guess is yes, right? Earnings, what do we know? It creates more volatility in the stock, so because of that, they price the options more expensively. The earnings premiums tend to decline after earnings when people kind of breathe a sigh of relief and say, okay, the unknown became known, not too big of a deal. So it's priced at $3 here. Well, if we look at that and we say, hypothetically next week we pull the with earnings straddle, we need to pull it before they've reported, and we pull the at the money straddle, wouldn't surprise me if it was going for, $4.50 or something like that. So what's the earnings premium? All of us can answer that. If a normal straddle for this stock is going for $3, and this week with earnings it's going for $4.50, there's an extra $1.50 being priced in due to earnings or what have you. And it can be, more extreme than that. So don't look at this in terms of, a situation where just because the stock is going to move more than normal on earnings, that you should always buy straddles into the event. You've got to be kind of selective. Ideally, you would find situations where you feel like they're underestimating the movement and the potential. If you could find that, that would be a great result to buy the straddle. If you feel pretty confident that they're overestimating the amount of volatility, then you'd put on short vol strategies. Again, limit your risk, but you try to take advantage of it kind of that way. So that can be an exercise. We could look at next week's. It won't be a perfect example, but Kohl's next week earnings right now is going for 340 by 330. So next week's, we said this week's straddle is going for $3. Next week's is going for 340 and 330. So you're at what, 670? That's next week's, which includes earnings. Well, it's not a perfect comparison because this will lose some time value. In other words, we should really be looking at this one next week for an apples to apples comparison, because then it'd be an equal number of days to expiration and it would just give us a comparison. But having said that, I wouldn't be surprised if this loses some time value. We could even guesstimate on that. So let's look at our theta numbers here. Let's guesstimate how much the theta is going to decay. I need to widen out my theta here. If I can get that to cooperate. Here we go. Well, maybe. When I pull it out, we can at least see it. It'll cooperate. There we go. So 78.50, we've got 16 cents and 16 cents. So this straddle is losing, in other words, just in time decay. That's what the theta shows us, how much time decay those options are experiencing on a day-to-day basis. Well, our calls are losing 16 cents per day and the puts are losing 16 cents per day. So that's a drop of 32 cents per day. If we fast forward a week, it's 32 cents times 7. So that puts us at $2.24 less than current prices. You may have a little bit of a tick up in some volatility and some other things, but we can make an educated guess that maybe there's about $2.24 of decay. The 670 straddle would be trading for about 446, 450. We'll round it up. It's 446, 670 minus the 224 of decay over the next 7 days would put us at 446, but I'm going to call it 450. So that's your earnings premium. This week's without earnings, trading for 3. Next week's with earnings, trading for 450, and it'll be in that ballpark. You know, my guesstimate was probably pretty good, where there's a premium, an earnings premium or extra pricing in of about $1.50. So that seemed like a lot. Does that seem like not enough? You know, we'd make those assessments before entering into a trade. You can do this type of homework on any position out there. You've got an earnings calendar you can go to. You can track the history of what they're pricing in. You can also track the performance. How did this stock do over the past few? And a lot of these will have a history of underwhelming or being more volatile than what the market's pricing in. Would it be better or similar probability to place a straddle on a historically less volatile stock? That's absolutely better if you get a big move. So as an example, we talked about Walmart. Well, Walmart is so boring that nothing's going to be priced into the straddle, right? Because it just doesn't do a lot. And so I'll show it to you. So take Walmart. It's at $90.95 per share. We'll come over here and we'll say, okay, Walmart. Okay, at the money straddle, $90.95. It's pricing in 180 and 185. So 180 for the calls, 185 for the puts. We add those together, and that gives us $3.65. But the stock is a $91 share price. So think of it in percentage terms. They're pricing in $3.65 of movement divided by a $91 share price. That's 4%, right? So it's just not that exciting. It's actually a little higher than what I expected. You know, Nvidia is going to be a lot higher. Kohl's was in that neighborhood a little bit more, but they're only pricing in a 4%. Now let's say that Walmart, something goes wrong, something goes right, and that stock makes a huge move. It's even better because you didn't pay much. And if you get the big move, fantastic. You know, there's a big payoff. So if Walmart was to collapse, given its low volatility expectations, that would be a home run scenario. Much more than Nvidia collapsing because they're pricing in more volatility. Okay. And so that's kind of a good way to think of it. Let's do Nvidia since we're on the topic and doing a comparison. So Nvidia is at the money straddle. If we put it into percentage terms, stock's around 260-ish. We know the straddle was going for, what was it, 1590, something like that. So 1590 on the straddle divided by its share price of 260. So 1590 divided by 260 is 6.1. So 6.1% versus Walmart's at 4. And you know, this seems pretty reasonable given that Nvidia probably will be more volatile than Walmart over its earnings here in the next little bit, right? So you can look at comparisons that way. It's kind of like, you know, how much were they pricing in versus the expectation. If two assets moved the same amount, but you had bought the volatility on the lower priced one going in, you'd have a bigger payoff, of course. The expectation would be, though, that the more volatile the asset is, the more probable it is for the really big move. So there's kind of a trade-off. All right, great questions. Nice work, everyone. We'll leave it there. See you next time. Bye.